Today, you're going to learn how to pay off your mortgage in 5 to 7 years. That might sound hard to believe at this moment, but if you stay tuned to the video, I am going to give you information on how this strategy works. Hi, my name is Stephen Scott with FirstLienHelocs.com. Before we get started, I want to give a big shout out to HomePayoffSecrets.com for sponsoring our video. If you want to see step-by-step on how this strategy is laid out as well as how to build wealth with the first HELOC, go grab their free book called Home Payoff Secrets at HomePayoffSecrets.com/ebook. I will also drop a link in the description below. Now let's get into this strategy. So you probably have this 30-year mortgage looming over you. Let's use an example of $200,000 mortgage with a 4% interest rate for 30 years. Your payment is going to be about $950 per month. The banks have rigged the system so the bulk of your payment each month is going right to interest. In fact, it's not until about year 12 does this really start to change. Your principal balance has barely even fallen. What most homeowners do is refinance several times and it starts the clock right back over. When you closed on your mortgage, there was a page called the Truth in Lending Statement. On it, it shows that deposit only having a 4% interest rate, you are actually paying a lot more because of the total interest paid. You're basically paying double for your house. Double. One house for you and one house for the bank. Sucks, right? I think most homeowners know in their gut that they are getting screwed, but they have no clue what to do about it. That's why we made this video for you, so we can show you a better way, backed by math, where you, the homeowner, won't pay 100% on your real estate. Go ahead and smash the like button right now if you are fed up with the banks like we are. I am curious, how many of you have noticed the Truth in Lending disclosure when you closed? What did the total interest paid say? Comment below. Okay, so what we like to use instead of a mortgage is a first lien position HELOC or home equity line of credit. Some call this strategy velocity banking. It's been around for years, but it isn't really talked about. By using this strategy, we can cut down the time and interest that you pay for real estate by a whopping 66%. This is without changing your lifestyle either. Same income and same expenses. After you watch this video, you can run your own numbers with our free HELOC calculator to see how fast you can pay off your home loan. The link is in the description. So what you're going to do is get a home equity line of credit. You might already be asking yourself the question, but aren't HELOCs variable interest? And the answer is yes, they are. But I'm going to show you that it doesn't matter as much as you think. You see, the banks want you to get a 30-year debt trap. They want to keep you paying tons of interest. This is why all you really see are ads for new mortgages and refinances. With a mortgage, it is a close-ended, which means once you make the payment, that money is gone. With the HELOC, it is open-ended so the money can move in and out of that account without penalties. You could actually make a payment on your HELOC and get it right back out the next day. One big advantage is using a HELOC is the interest is calculated on the average daily balance. So if your balance is $100,000 and you deposit $10,000 into your HELOC account, you now owe $90,000. So will you be charged interest on $100,000 or $90,000? $90,000. The longer you can keep money in your HELOC account, the less interest that you will pay. So instead of your money sitting in your checking account doing nothing, put it in your HELOC account and make 4% interest on your money by driving the balance down. Does that make sense? Go ahead and post your questions down in the comment right now. I will reply to each one of them. Okay, so we're going to refinance our house into a first position HELOC. You'll need at least 10% equity in your home to get approved. So let's say your home is worth $200,000. The bank will give you a $180,000 HELOC on your home. Maybe you owe $150,000. So you could have $30,000 that you could use if the opportunity presents itself. More on that in another video. You will now start dumping all your money into the HELOC and drive that $150,000 balance down and pay less interest. Nothing changes with your expenses. They still come out every month, but now you're paying them out of your Heloc account. However, the bills are not coming out all at once. That money that you deposited is sitting there driving the balance down and causing you to pay less interest. This will drastically cut down on how long it takes you to pay down your home by using this strategy. In fact, the guys over at homepayoffsecrets.com hired 5 math experts and gave them 2 scenarios: a mortgage versus Heloc. The Heloc one because it's simply based on math. If you like this video and want to see more of them, be sure and subscribe to our YouTube channel right now. Just click on the subscribe button below this video. And if you'd like a free Heloc calculator to determine how fast you can pay off your own home, just visit firstlienhelocs.com and sign up right on the homepage. It really is free. Now I want to turn it over to you. Will you be implementing the Heloc strategy yourself, or will you be sticking to a traditional mortgage, and why? I would love to hear either way. Let me know by leaving a comment right now.
Okay.
All right, there needed to be like a comment. Okay, I just left the screen. Yeah. Or will you be sticking to a traditional?
Yep. Just kind of like.
So you probably have a 30-year mortgage. Dang it! What most homeowners. Okay, Steve. In fact, your basic.
Like,
how many of you? I am curious.
Yeah,
curious.
if you